Welcome to the Deep Dive. We're here to cut through the noise, get you really well informed on the big shifts happening right now. So imagine a world with just trillions of dollars in real-world value. Things like skyscrapers, fine art, even government bonds basically stuck. Illiquid, hard to access. Now, what if there was a bridge? Something that could unlock all that value, make it instantly liquid, globally tradable, open to pretty much anyone. That's the huge promise of real-world assets, or RWAs. And today, we're diving deep into whether that promise is, actually becoming reality and what it means for you, for investments, for ownership itself.
And it's not just some value. When we talk about unlocking value, the scale is immense. We're talking analysts estimating the total addressable market for this, for RWA tokenization, in the hundreds of trillions of dollars.
Hundreds of trillions. Wow.
Yeah, I mean, just to give you some perspective, that figure absolutely dwarfs the current market cap of the entire crypto space combined. It's huge. So it's really no surprise then that you see major players, the big institutions like BlackRock, like Franklin Templeton, they're not just watching, they're jumping in, launching their own tokenized funds pretty aggressively.
That's a serious commitment.
It's a huge validation, a powerful validation of this whole RWA idea.
Okay, so our mission today is to basically demystify this whole thing for you. We're going to unpack the mechanics. How do these assets actually move from the physical to the digital? We'll explore the benefits, which sound pretty powerful. We'll look at key players like Plume Network, who are building the infrastructure for this, and then really dig into the long-term implications. Think of this as your shortcut, your way to get up to speed on something that's genuinely reshaping finance as we speak. So let's start right at the beginning. The fundamental question: what is a real-world asset in RWA in this whole context?
Right. Simply put, it's a digital token. And that token represents ownership of an asset that exists off-chain, outside the blockchain world.
Like a digital twin.
Exactly, a digital twin, for something real or something from traditional finance.
And what kind of things can become these digital twins?
Well, that's the exciting part. The potential scope is almost limitless. But we can kind of break it down into maybe three big categories. First, you've got your tangible assets. Physical stuff you can touch, like real estate buildings, land, fine art, a specific painting, precious metals, gold, silver, commodities, even things like industrial machinery.
Okay, physical things. What else?
Then you have intangible financial assets. These are more your traditional instruments. Think government bonds, US Treasury bills are a huge one right now, corporate stocks, private credit, so loans between companies, trade finance invoices, even stakes in venture capital funds.
Right, the stuff banks and funds deal with.
Exactly. And then there's a third category, sort of emerging asset classes, newer markets being tokenized, things like carbon credits, intellectual property rights, even future revenue streams from sports teams or entertainment deals.
Wow, that's an incredible range. It really could be almost anything with value. But why now? What's the trigger? Why is this suddenly gaining so much traction?
It's a fascinating convergence, really. It comes down to the macroeconomic climate we've been in. For a while, you had pretty high interest rates in traditional finance, right? But at the same time, the crypto market was kind of searching for yield that was sustainable, less speculative, something more stable than just, betting on the next hot token.
Looking for real return.
Exactly. Real stable yield. And that created this perfect storm for RWAs. You saw this clear market preference, especially for debt-based high-yield investments. This is what drove the early success, the really explosive growth of things like tokenized US Treasuries. Projects like Ondo Finance, for example, jumped on this and became leaders very quickly.
Right. Ondo's treasuries were everywhere for a bit.
They were. And their success wasn't just about Ondo. It served as this crucial proof of concept for the whole RWA model. It showed institutions, hey, this works, it's compliant, people want it, and that built confidence, laid the groundwork for moving into, more complex stuff beyond just treasuries.
That makes perfect sense. The timing was right. So, okay, there's huge interest. How does it actually happen? How does, say, a building or a bundle of loans go from being just that to being a token on a blockchain? You said it's meticulous?
Oh, absolutely. It's not just flipping a switch. Think of it as a three-phase journey. It needs legal expertise, financial structuring, and, of course, the tech side. Phase 1 is all off-chain formalization. This is the foundation. You have to legally and financially prep the asset. So that means selecting it, valuing it accurately and critically, establishing absolutely clear, undeniable legal ownership.
Getting the paperwork right, basically.
Exactly. And often this involves creating what's called a special purpose vehicle, an SPV. Think of it like creating a brand new, Clean little company, a legal box, just to hold that one asset.
Like a container.
Precisely. So maybe you put an office building into an SPV. Now that building is legally separate from the original owner's other business. If the original owner has problems, the building inside the SPV is protected, isolated. This is huge for mitigating risk for the token holders. Alongside setting up the SPV, you draft comprehensive legal documents, prospectuses, agreements, everything needed to ensure you're following all the rules, all the regulations.
Okay, so that's the legal house in order, phase 1 done. Then how does it actually become a digital token? Phase 2, the tech part?
Right, that's the on-chain mechanism phase. This is where the digital twin is actually born. You make some key technical decisions here. First, you pick the blockchain. Will it be a big one like Ethereum, or maybe a specialized chain built just for RWAs like Plume? Then you choose the token standard.
Like ERC-20.
Exactly. If the asset is fungible, meaning divisible and interchangeable like shares in a pool of bonds, you'd probably use ERC-20. But if it's a unique, one-of-a-kind asset, like one specific painting or one particular house, then an NFT standard like ERC-721 makes more sense. Each token represents that unique item.
Got it. Fungible versus non-fungible.
Then you develop the smart contracts. This is the code that lives on the blockchain and automatically enforces the rules of the asset. Things like who owns it, who it can be transferred to, maybe only accredited investors, for example, and how any income or yield gets distributed. And because real money is involved, these smart contracts need rigorous security audits by third-party experts. You absolutely have to get this right.
No room for error there.
None. Finally, you actually mint the tokens. Create them on the blockchain. And this involves a critical step, linking them verifiably to the off-chain asset. This is where Oracle networks, especially Chainlink, play a huge role.
Ah, the oracles, connecting the chains.
Precisely. Chainlink's proof of reserve service, for instance, provides continuous, cryptographically verifiable proof that the underlying asset, the gold in the vault, the dollars in the bank account, is actually there, held in custody. It's like a real-time, transparent audit trail for investors.
Yeah.
It builds trust.
That's a massive piece. Constant verification. Okay, so the legal work is done, the tech is built, the tokens are minted and linked. Phase 3, where do they go? Marketplace deployment.
Exactly. Phase 3 is getting them out there. The newly minted RWA tokens get listed on specialized marketplaces. Platforms like Securitize are known for this, or even on decentralized exchanges, DEXs. This makes them available for trading. But the really powerful part is their integration into the broader decentralized finance, the DeFi ecosystem. They're designed not just to be bought and sold, but to be used.
Used how?
Well, they can be used as collateral to take out loans in DeFi. They can be staked locked up to earn additional yield, or they can be bundled into diversified investment pools alongside other crypto assets. It unlocks all sorts of new financial strategies and possibilities.
Okay, so that whole 3-phase process sounds pretty involved, definitely complex. What are the big payoffs? Why go through all that effort? What are the core benefits that justify tokenizing, say, a building, instead of just selling it the old way?
The value proposition is really strong, and it hits on some major inefficiencies in traditional finance. First, enhanced liquidity. This is probably the biggest one.
Right, unlocking stuck value.
Exactly. Think about a big commercial building or a rare piece of art. Traditionally, these are super illiquid. Selling them can take months, even years. Tokenization lets you digitally slice it up into thousands of little pieces, little shares represented by tokens. Suddenly, you can sell those shares on a global market, 247. It turns a frozen asset into dynamic capital.
Makes sense. What else?
Second, democratization of investment through fractional ownership. Those high-value assets, prime real estate, private equity funds, fine art, they used to be totally off-limits to regular investors. You needed millions.
Yeah, exclusive clubs.
Right. But if you tokenize that asset into, say, 10,000 tokens, suddenly someone with just a few $100s can buy a piece. They can get exposure to assets they could never access before. It opens things up dramatically.
That's powerful. Accessibility.
And there's operational efficiency and cost reduction. Smart contracts automate so much stuff. Compliance checks, dividend payments, settling trades. It cuts out a ton of manual paperwork, reduces the need for middlemen, and shrinks transaction times from days or weeks down to minutes. Big cost savings.
Less friction, fewer fees.
Exactly. And finally, radical transparency and security. Because it's on a blockchain, the ledger of who owns what is immutable can't be secretly changed, and it's publicly verifiable, or at least verifiable by authorized parties. This provides a clear, auditable history of ownership, which really helps reduce fraud and disputes.
Okay, those are some compelling benefits: liquidity, access, efficiency, transparency. But I know there's a catch, or at least a critical nuance we need to talk about. You mentioned it earlier, the centralization paradox. Can you unpack that? Like, if I own a token representing a share of that building, what happens if the company holding the actual deed goes bust?
Yeah, you've put your finger on probably the most fundamental tension in the RWA space. It's crucial to understand this. While crypto, the whole ethos is about decentralization, removing intermediaries,
Mm.
an RWA token's value is ultimately completely dependent on a centralized off-chain legal structure and a trusted physical custodian.
So not like Bitcoin.
Not like Bitcoin at all. With Bitcoin, if you hold the private key, you own the Bitcoin. Full stop. An RWA token is more like a sophisticated digital IOU. It's a claim on an underlying asset held elsewhere. So the transfer of that token on the blockchain can be decentralized peer-to-peer. But the validation that the token actually represents ownership and the enforcement of that ownership if something goes wrong, that relies entirely on the traditional legal system and the integrity, the solvency, the honesty of that off-chain custodian holding the actual asset.
Which brings back old risks.
Exactly. It reintroduces traditional counterparty risk. What if the custodian commits fraud? What if they go bankrupt? What if the government seizes the asset they're holding? These are real-world risks that blockchain alone can't eliminate for RWAs. It's this custodian oracle problem. You're trusting both the physical holder and the data provider, telling the blockchain the asset is still there. It's a hybrid world.
That paradox really frames the whole challenge. It's bridging worlds, but also inheriting risks from both. So let's look at how projects are tackling this. You mentioned Plume Network earlier as a key player building new infrastructure. Tell us about Plume. What's their approach?
Right. Plume Network is interesting because they're positioning themselves as the first modular blockchain specifically designed for RWAfi. That's their term. Real-world asset finance integrated with DeFi.
RWAfi.
Yeah. Their core mission is basically to make it radically simpler for two groups. First, the asset issuers, the people bringing real-world assets onto the blockchain. They want to simplify the onboarding process for any RWA. Second, for the users and developers in DeFi, they want to simplify the utilization of these assets within DeFi applications. So the goal is to kind of abstract away all that complexity we talked about, the tokenization steps, the compliance hurdles, make it much more seamless, more accessible for everyone involved.
Okay, simplifying onboarding and use. How are they doing that technically? What's under the hood?
Their architecture is built as a specialized Layer 2 network, an L2. Specifically, they're using the Arbitrum Nitro stack.
Ah, Arbitrum, so connected to Ethereum.
Exactly. That gives them immediate EVM, Ethereum virtual machine compatibility. So developers familiar with Ethereum can easily build on Plume using the same tools, and importantly, it inherits Ethereum's security guarantees while operating as a faster, cheaper Layer 2. What's also really notable is their use of Celestia as their data availability DA layer. This is a technical choice, but the upshot is potentially huge cost savings. By offloading the transaction data to Celestia, Plume is projecting something like a 99.9% reduction in gas fees compared to Ethereum mainnet.
Wait, 99.9% reduction in gas fees?
That's the projection, yeah.
Wow, okay, that completely changes the economics, doesn't it? Especially if you're doing lots of small transactions or managing complex assets. That's a potential game changer.
It really is. Makes a lot of RWA use cases economically viable that might not be otherwise.
So beyond that core architecture, what are the specific components that make Plume's integrated approach work? What are the building blocks?
They talk about a few key pieces. There's Plume Arc. Think of this as their tokenization engine. It's the solution for the asset issuers, the supply side. It's designed as a modular kind of plug-and-play toolkit to help bring basically any RWA on-chain relatively easily.
Okay, the issuer toolkit.
Then there's Plume Nexus. They call this the data highway. It's essentially their integrated oracle system. It's designed to stream real-time off-chain data, things like asset valuations, maybe credit scores, commodity prices directly to the smart contracts on Plume. This enables dynamic pricing, sophisticated financial products that react to the real world.
Critical data feeds built in.
Right. But perhaps the most significant differentiator, especially thinking about that regulatory future we discussed, is their embedded compliance and smart wallets. This is a big one. Plume has built infrastructure for KYC, know your customer, KYB, know your business, and AML, anti-money laundering OFAC, greening directly into the blockchain layer.
Compliance at the base layer.
Yeah. And they support a specific token standard called ERC 3643. This standard is compliance aware. It means the token itself can programmatically restrict transfers, allowing them only between whitelisted wallets that have passed the necessary compliance checks. Their smart wallets also aim to simplify the user experience, making it easier for people to onboard and manage these compliant assets.
That sounds very forward-thinking, building compliance in from the start rather than bolting it on later.
Yeah.
What about their own token, the PLUME token? How does that function in their ecosystem?
So the PLUMEN token has a max supply set at 10 billion. Interestingly, they've allocated a large chunk, 59%, to community and ecosystem growth. That usually signals a focus on building a strong, decentralized network long-term.
And its uses?
It has four main utilities they've outlined. First, it's used to pay for gas fees on the network, those super low fees we talked about. Second, governance token holders can vote on the future direction of the protocol. Third, staking validators need to stake PLUME to secure the network and earn rewards. And fourth, providing liquidity within the Plume DeFi ecosystem itself.
Got it. Gas, governance, staking, liquidity. Pretty standard utilities. Now, what about partnerships? Building an ecosystem needs users and assets. Have they made any significant moves there?
They definitely have. They seem to be pursuing what you might call a chicken and egg strategy, actively building both the supply side assets and the demand side DeFi apps simultaneously. They've apparently got significant traction even before a full public launch, mentioning over 180 projects already building on their testnet.
180 projects, it's quite a bit of early interest.
It is. But the real headline partnership, the cornerstone move, is their alliance with Ondo Finance. They've worked to natively integrate Ondo's main product, USDY, that's Ondo's yield-bearing token, backed by US Treasuries, directly into the Plume ecosystem.
Bringing in that established, high-quality RWA right from the start.
Exactly. It's a profoundly strategic move. It instantly seeds the Plume ecosystem with a highly liquid, institutional-grade RWA. It gives developers a foundational money Lego, as they say, to build other DeFi applications on top of. Plume's CEO, Chris Yin, was quoted saying something like, "The key to adoption is the ecosystem and user experience." This Ondo partnership directly addresses the ecosystem part, bringing immediate value and liquidity.
That's a very smart way to bootstrap activity. Okay, so we've looked at Plume. Thinking more broadly about the RWA sector, how should we frame the competition? Is it Plume versus Ondo versus Centrifuge versus others, or is it more collaborative like you suggested earlier?
It's definitely more nuanced than direct head-to-head competition for most players. The best way to think about it is as a multi-layered stack. Different projects specialize in different functions, and often they're complementary, even dependent on each other. Take Plume Network and Ondo Finance. As we just discussed, it's not competition, it's a symbiotic partnership. Ondo is the asset issuer, the sell side. They do the hard work off-chain. Sourcing deals, structuring products like tokenized treasuries, handling custody. Think of them as bringing Wall Street 2.0 assets onto the blockchain.
Okay, Ondo creates the assets.
Right. Plume Network is the RWAfi ecosystem, the buy side. They provide the specialized blockchain environment, the fast, cheap, compliant L2, where assets tokenized by Ondo and others can be traded, used as collateral, integrated into DeFi. Plume is more like the Robinhood 2.0 for these tokenized assets. They need each other.
That makes sense. Partners, not rivals. Well, what about Plume versus, say, Centrifuge? They both work with RWAs.
That's a better comparison to see different approaches. Looking at Plume versus Centrifuge, you see different choices in architecture and strategy. Architecturally, Plume is, as we said, an EVM-compatible L2 built on Arbitrum. Their strategy is integration with the massive Ethereum ecosystem, developers, users, liquidity. Centrifuge, on the other hand, built its own sovereign blockchain using Substrate and operates as a parachain within the Polkadot ecosystem. This gives them more customization and independence, but means building their own distinct community and liquidity bridges.
Different technical paths. What about their focus?
Their target markets also seem different, at least historically. Plume appears to be building a broad, horizontal platform aiming to support almost any type of RWA. Centrifuge initially carved out a strong niche focusing specifically on private credit. They enabled small and medium-sized businesses, SMEs, to tokenize real-world assets like unpaid invoices, and then use those tokens as collateral to borrow stablecoins from DeFi lenders.
So Plume is broad. Centrifuge started with a specific niche.
Right. And their approach to risk management differs too. Plume is emphasizing that proactive embedded KYC/ML compliance at the base layer. Centrifuge is known for pioneering innovative on-chain credit risk tranching. They pool assets together, then slice the pool into different risk levels, a safer senior tranche and a riskier, higher-yield junior tranche. Investors can then choose how much risk they want to take within that pool.
Interesting. Different ways to handle risk. But underlying all these platforms, you mentioned oracles are essential.
Absolutely indispensable. You cannot overstate this. No RWA protocol, not Plume, not Centrifuge, not Ondo, can function in a vacuum. They are all fundamentally dependent on reliable Oracle networks, primarily Chainlink, to securely bridge the on-chain world with off-chain reality.
Chainlink's everywhere in this space.
It really is the backbone for data. Their proof of reserve, POR, as we discussed, provides that automated on-chain verification that the off-chain assets backing the tokens actually exist. It connects to bank APIs, custodian reports, whatever is needed. Their data feeds are crucial for supplying secure, real-time price information for asset valuation, commodity prices, interest rates, real estate indices. You need accurate data for lending, liquidation, everything. And as RWAs start appearing on multiple blockchains, Chainlink's cross-chain interoperability protocol, CCIP, becomes vital. It allows RWA tokens and their associated data to be securely transferred between different chains, preventing liquidity from getting trapped in silos.
So understanding the RWA space isn't about picking one winner. It's about seeing how these specialized pieces, the issuers like Ondo, the platforms like Plume and Centrifuge, and the foundational oracles like Chainlink, all fit together in these complementary stacks.
Exactly. It's an ecosystem play.
Okay, shifting perspective again. Looking at the bigger picture, how are RWAs changing the whole crypto ecosystem? Is this a catalyst for a new phase of DeFi?
I think it absolutely is. Many people are calling this the dawn of DeFi 2.0, and RWAs are arguably the main catalyst. Think about DeFi 1.0, the early days. It was groundbreaking, but also very insular, right? Built mostly on volatile, self-referential crypto assets, borrowing ETH against WBTC, things like that. This led to crazy leverage and those painful cascading liquidations we saw during market crashes.
Yeah, the whole system felt fragile sometimes.
Exactly. DeFi 2.0, integrating RWAs, brings a new level of potential stability. When major stablecoins like MakerDAO's DAI start using real-world assets like treasury bonds or real estate loans as collateral, it diversifies their backing away from pure crypto volatility. It makes them potentially more robust. It also fundamentally shifts the source of yield. Instead of just yield farming highly inflationary tokens, you're tapping into sustainable real yield from outside the crypto system, rental income, bond interest payments. This provides a more predictable, traditional foundation for returns in DeFi.
Real yield from the real world.
Right. And RWAs unlock entirely new financial primitives in DeFi. Imagine getting a loan based not just on your crypto collateral, but maybe on your tokenized real-world credit history, or creating sophisticated derivatives tied to the performance of a specific basket of tokenized commercial real estate. The design space just explodes.
But there's a flip side to that integration, isn't there? You mentioned the re-centralization risk.
Yes, that's the paradox. While RWAs might enhance stability in some ways, bringing large amounts of traditional assets on-chain also means DeFi becomes much more exposed to traditional financial and even political risks. A crisis in the real estate market could now directly impact DeFi protocols holding tokenized mortgages. A major custodian going bankrupt, or a government seizing assets held by a custodian, these become systemic risks for DeFi in a way they weren't before.
So less crypto volatility risk maybe, but more real-world contagion risk.
Potentially, yes. It's a trade-off.
Now, another point of confusion often comes up. RWAs versus NFTs. People hear tokenizing a painting and think NFT.
Yeah.
Can you clarify the relationship?
Yeah, it's a good question because the terms overlap but mean different things depending on context. The core difference lies in the value proposition. For RWAs, the value comes from the underlying asset's intrinsic economic utility and its cash flows. It's objective, mostly. A bond pays interest based on rates. A building generates rent based on leases. It's tied to real-world economics. For NFTs, at least in the popular sense of digital art or collectibles, the value derives primarily from digital scarcity, cultural relevance, community, and subjective factors. What someone is willing to pay for that specific, unique digital item.
Okay, so RWA value is economic. NFT value is often subjective or cultural.
Right. But here's the technological convergence. NFT is technically just a term for a token standard, like ERC 721, designed for unique, non-fungible items, something where each token is distinct. So when you tokenize a unique, non-fungible real-world asset, like one specific house with its own address, or one particular masterpiece painting the NFT technical standard ERC 721, is actually the most appropriate technology to use.
Ah, so the RWA is an NFT in that case, technologically speaking.
Exactly. In that specific context, the technology is NFT, but the asset class is RWA. The key distinction for an investor is always, Where does the value come from? Is it the underlying real-world economics, RWA, or the digital uniqueness and perception, typical NFT collectible?
That's a really clear way to put it. The tech standard versus the source of value. It reminds me, thinking historically, you compared DeFi 1.0 to the early internet. How does this RWA evolution fit that analogy?
I think it fits perfectly. DeFi 1.0 was like the early internet, a fascinating self-contained ecosystem, mostly used by enthusiasts and builders, proving the core technology worked but largely disconnected from the mainstream economy. RWAs are like the arrival of e-commerce, online banking, streaming services the moment the internet started deeply integrating with and transforming the real global economy. This connection makes a technology exponentially more useful, more powerful, applicable to everyone, but just like the internet's commercialization brought challenges, this RWA integration means the crypto ecosystem now has to seriously grapple with real-world complexities. Regulation, legal frameworks, the need for trusted intermediaries in some cases dealing with different jurisdictions. It's the price of going mainstream.
Growing pains, but potentially enormous growth. So as this sector matures and connects more deeply with the traditional world, it's inevitably going to face some serious hurdles. What does the risk matrix look like for RWA tokenization? It feels like a blend of old and new dangers.
It absolutely is a hybrid risk matrix. You've got risks from both worlds colliding. We can break them down. First, market and financial risks. Even if you tokenize an asset, there's no guarantee of secondary market illiquidity for very niche tokens. If you tokenize something super obscure, finding a buyer might still be hard. And fundamentally, you still have credit and default risk. If the borrower behind the tokenized loan defaults or the underlying asset itself tanks in value, the token holders lose money, just like in TradFi.
Okay, standard market risk supply.
Then, technological and security risks. Smart contract vulnerabilities are always a concern in crypto. A bug or exploit in the RWA protocol's code could lead to funds being drained. And there's oracle manipulation risk. If someone can feed bad data a false price to the oracle, it could cause wrongful liquidations or mispricings within the RWA protocol.
The tech needs to be flawless.
Or as close as possible. Then you have the big one, regulatory and legal risks. The specter of securities law looms large. Most RWA tokens look and smell like securities, meaning they'll likely fall under SEC regulation in the US and similar bodies elsewhere. That triggers very costly registration and compliance requirements. There's also regulatory fragmentation. The rules might be different in every country, making global RWA platforms complex to operate. And perhaps most importantly, the legal enforceability of on-chain ownership is still being tested in courts. If there's a dispute, will a traditional court recognize the blockchain record as definitive proof of ownership, especially against conflicting off-chain documents? That's not fully settled everywhere.
Huge legal uncertainty still.
Huge. And finally, operational and custodial risks. This brings us back to that custodian-oracle problem. You're fundamentally reliant on the trustworthiness of the physical custodian holding the asset and the auditors verifying it. And there's custodian failure risk. What if the custodian goes bankrupt, commits fraud, or has the assets seized by a government? The token could become worthless no matter how secure the blockchain itself is.
That's a sobering list of risks, definitely. Yeah. A complex web. But despite all that, the momentum you mentioned earlier seems undeniable. What are the key things driving growth forward, making institutions willing to navigate these risks?
I think there are a few powerful drivers. The biggest is simply the institutional stampede. When you see BlackRock's BUIDL fund attracting billions almost overnight, when Franklin Templeton is deeply involved, when giants like JP Morgan and even Swift, the traditional financial messaging network, are actively experimenting and building infrastructure for tokenization, that sends a massive signal. The big players see this as the future of financial plumbing.
The smart money's moving in.
Decisively. And this is reflected in the explosive market growth metrics. The total value locked, TVL, in RWA protocols just exploded, something like a 700% increase from early 2023 to mid-2024, approaching $8 billion. And the forecasts are staggering. McKinsey suggests $2 trillion, maybe even $4 trillion in tokenized assets by 2030. Boston Consulting Group has even higher long-term projections. The scale of the opportunity is just too big to ignore.
Trillions on the table.
Exactly. And looking longer term, the implications for finance are profound. RWAs genuinely have the potential to create a new global financial market infrastructure, one that's more efficient, more transparent, more inclusive, democratizing investment access, enabling programmable finance in ways we're only just beginning to explore. That's the grand vision pulling everyone forward.
So with that kind of potential and institutional momentum, it feels like a collision course with regulators is inevitable, especially as RWAs touch really core markets like securities and real estate.
Oh, it's not just likely, it's happening. As RWAs move beyond niche experiments and start involving systemically important assets, regulators like the SEC and their counterparts globally will intervene to establish clear rules of the road. They have to. But what's interesting and perhaps positive is seeing projects like Plume proactively building compliance features, the KYC, the AML, the compliant token standards, right into their core infrastructure. It shows the industry is anticipating this, building for a regulated future, not just reacting to enforcement actions after the fact.
Trying to get ahead of the curve.
Exactly. And my personal take is that this regulatory push will likely lead to a long-term bifurcation of the broader crypto market. You'll probably see a regulated, permissioned RWAfi sector emerge, focused on compliance, attracting potentially trillions in institutional capital for things like tokenized bonds, real estate, private equity. And alongside that, you might have a separate, more permissionless, experimental, pure DeFi sector continue, perhaps focused more on native crypto assets and innovation outside the traditional regulatory perimeter. RWAs, in essence, might be the catalyst forcing this great sorting within crypto, fundamentally reshaping both the traditional financial world and the digital asset space.
We've covered a huge amount of ground today, really unpacked the transformative potential of these real-world assets as critical bridge connecting traditional finance and the blockchain world. Our goal was to cut through the hype and the complexity, give you the essential understanding.
And maybe a final thought for you, the listener, to chew on. If this RWA-driven great sorting really happens, if we see this split between a regulated RWFi world and a more permissionless DeFi space, how might that evolving landscape change the way you think about owning things, about investing, maybe even about the fundamental nature of value itself in the coming years? Because it suggests a really profound shift in how assets might be owned, managed, and traded globally. And it's not science fiction, it's happening now.
That's a powerful question to end on, highlighting just how fundamental this shift could be. Thank you for joining us on this deep dive today. We really encourage you to keep exploring this fascinating, fast-moving intersection of finance and technology.